Hey, welcome back to another Whiteboard series. Today we're going to be covering dividend reinvestment. This is a part of your portfolio management that you may or may not be aware of, so I just want to talk about it and why you should think about it, how it can help you grow your portfolio potentially a little bit faster. So real quick, let's talk about what a dividend is. A dividend is a payment of earnings to shareholders from the corporation. They're usually paid out quarterly, sometimes they're paid out in the form of additional stock, but they can also be paid out in the form of cash. And those are the ones I want to talk about today. When you get your dividend paid out, you really have two options. You can collect the cash, put it in your savings account, you can go spend it. Our grandparents use them for income. Or if you don't need the cash, you can turn around and reinvest that back into the fund that it came from. And that's what I want to talk about, because that reinvestment of those dividends is extremely powerful. So your mutual funds, your ETFs, and your stocks obviously are all going to pay out dividends. Take a step back. Not every stock, not every mutual fund pays out a dividend. You can do the research on those individual stocks and funds to see if they pay out dividends. But let's talk about the ones that do. So the funds that pay them out, when you turn around and reinvest those dividends, you are buying more shares of either that stock or that fund that you're investing in. So how does that help you? If you think back to our last Whiteboard series, we talked about the power of compound interest. Over the last 10 years, if you would have invested in the SPY, which is the SPDR ETF, tracks the S&P 500, if you would have invested in that and took your dividends as cash, your fund would have grown by 58%. Not too bad, but had you turned around and reinvested those dividends because you didn't need them, bought more shares, let it compound, you would have been up 95%. Big difference right there. Let's take a further step back, look at an even bigger picture. If we go back 30 years, because we're going to be investing for 30 years, you would have had 443% gain if you would have taken those dividends as cash and spent them. But if you would have reinvested them back, bought more shares, you would have seen a 757% return. So a big difference just by reinvesting dividends that at this stage of the game you probably don't even need. So when you set up your accounts, you actually have this option to choose: do you want your dividends paid to cash? Do you want your dividends reinvested? Some advantages above and beyond the compound interest, I don't think you need any more, but if you wanted more advantages, you get to set up what's called a dollar cost averaging program. We're going to talk about that actually on our next Whiteboard, so I'll tell you more about that next time, but it'd be setting up a dollar cost averaging program. You're also able to reinvest those dividends with no commissions. So whenever you buy and sell your stock or maybe some of your funds, you may have to pay a commission. When you reinvest those dividends, they go right back in with no additional commissions, so you're able to save a little bit cheaper. But again, the biggest reason to do it, I think, is for the compounding interest reasons. So next time you're setting up an account, next time you're meeting with your advisor, ask them if your dividends are set up to be reinvested. If they're not, have that conversation about whether or not that makes sense for you and your portfolio. A couple disclaimers before I head off today. First off, we talked about past performance of the SPY fund. Past performance does not predict the future, so we can't expect those types of returns going forward. Investing is always going to involve risk, and you should consult your financial advisor to determine how investing fits into your financial plan and whether or not you should be reinvesting your dividends. So I hope you learned a little bit more about dividend reinvestment. Again, the main power is the power of compounding interest. 95% versus 58% on a 10-year, same fund, only difference is reinvesting. 757 versus 443 over a 30-year period, same fund, only difference is reinvesting those dividends. It's a powerful component of your investing. It goes back to the first Whiteboard, which was the compound interest. So reevaluate your dividends. Do you need them? Are you reinvesting? And have a great weekend. Thanks a lot.